And welcome back. 6:33 on this Hump Day edition of the Lance Roberts Show right here at realinvestmentadvice.com. Just for the break, we were talking about this class that's coming up, doing planning, distribution strategies. And I said that, one of the things that, people assume here is that markets only go in one direction, which is up. And that's not actually the case. There are many periods throughout history where 10 and 20-year cycles of time go by with zero rates of return. People have forgotten that between 2000 and 2013, 13 years, on a total return basis, inflation adjusted, the return was zero. Now, we've forgotten about that because we've had this rip-roaring bull market over the last few years. But for a lot of people, just even this last decade of advances, a lot of people have just gotten back where they were prior to the last financial crisis. So if we look at it from that measure, almost 20 years have gone by for a lot of investors, and they're just now back to where they were in 2000. That's 20 years of time that people don't get back. Now, unfortunately, and I've got an article coming out on this tomorrow talking about one of the biggest problems that we are facing. It's assumed, a lot of people assume right now that the subprime crisis can never happen again. And when you talk about the mortgage crisis, people, well, we don't have anything in the market like that. $600 billion of subprime loans led to the crisis in the United States. That's a lot of money. Right now, we've got $1.6 trillion worth of leveraged loans in the market, which is basically subprime for corporate debt. It's twice the size of what we had in the mortgage market. $9.1 trillion in triple B rated debt because of low interest rate environments. And of that $9.1 trillion, $4.8 trillion, more than 50% of it is coming up for refinancing in the next 4 years. So if interest rates move up, we have a recession, credit qualities deteriorate, companies deteriorate fundamentally over the next few years, there's going to be a funding crisis for a lot of this debt. Lance, you're just being bearish. Don't worry about it. It's all going to work out fine. In 2007, I was writing about this very same issue related to subprime, which was the refunding and rewriting of loans of subprime debt. Everybody thought then there'd be no problem. All this debt would roll over. It didn't. You've got twice as big of a problem now coming up. Now, so why do I bring this up? Because we were just talking about before the break about the issue with why over the next 5 years, total returns on the S&P are slated to be about zero. Now, what that means is it doesn't mean that markets just go flatline, right? It means that somewhere in the next 5 years, there's going to be a fairly significant correction. Then markets are going to get back to where they were, where you are now, and your return over that period is going to be zero. And that's within the next 5 years. And there's a lot of factors that line up for that. Economics, time cycles, fundamental cycles, valuation cycles, technical cycles. It all points to the same thing, that returns are a function that are driven by value ultimately and by the household asset composite of money being invested. And when you have most of your money drawn back into the market where you are now, that means there's less buying power to drive prices higher. So you're going to have a reversion at some point. And this just happens throughout history, time and time again. And we always think that this time is different. And we start seeing headline stories about it's a Goldilocks economy, right? Bernanke said that in 2008. Before the crash.
Yeah, but Lance, it's been a Goldilocks economy for 3 years? And now if we look back to last January, we're right back to where we were. Essentially, we're right back to where we were in September. We've been trading sideways.
I know. But this is all part of it. It's how we feel. This is part of the cycle. And at the peak of a cycle, this is how we feel. Confidence is high. Unemployment is low, right? Unemployment hits record lows when market cycles are at their end, right?
That's right.
We don't start bull markets where everything is great, right? That's where bear markets start. You start bull markets where everything is absolutely the worst. And so we always forget about this. We get this backwards. So the point back to the class is that, if you're facing retirement, there's a lot of risk to retirement over the course of the next 5 to 10 years. And so if you're within that 5 to 10 year window, This is why it's important to both have a disciplined investment strategy to protect your capital, but it's also important to start the planning process for distribution strategies, because it's not just, a lot of these, I've been to a lot of these classes and seminars over the years, and what they always talk about, well, just take 4% out and you're fine. That is fine as long as asset prices are rising. What's
Correct.
important to understand is how do you do a distribution strategy of your assets during a market decline or during a bear market? That's the one thing that devastates most retirees in retirement.
It does. You can see a portfolio that's making 8% a year, and depending on when that 8% comes, or what the sequence of returns are, you could be in a lot of trouble. If you have those first couple of years or down years and you don't plan for that, you're going to have a hard time in retirement. You're likely going to run out of cash. Whereas if you have the wind at your back, you may have a little bit different story. So this is very crucial to when you get into retirement planning to ensure that you account for these types of scenarios. It's not only just accounting for those scenarios, but what do you do and how do you do it? That's one of the bigger parts I see is everybody says, oh, don't worry about it. You're going to be okay. Well, will you?
Yeah.
How do you know that? Have you actually done the plan? And so that, I think, is crucial. We talk about some of the myths around financial planning. A lot of that is, you're going to get an 8% sequence of return. It's going to be the same every single year going up. Like we've talked about frequently, we see 8, 9, 10, 11, 12% returns. Heck, if you turned on Dave Ramsey, he's going to tell you, buy a growth mutual fund, you'll make 12% every year.
Yeah, it's never happened.
No, it doesn't. Exactly. And so the problem with these types of things are it gives us a false sense of security. Lance, you and I were talking yesterday about how we're seeing some of our very, very conservative clients who all of a sudden feel like taking more risk. And they say, well, there's a Trump put. Trump's not going to let the market go down. The Fed's not going to let the market go down. There's a number of reasons. But yet we know that something's going to happen. It's not a matter of if, it's just a matter of when.
Right.
And so,
and that's not being bearish, by the way. That's just understanding that we're very, very late in an economic cycle. And
correct.
It doesn't matter, what the Fed does. It doesn't matter what Trump does. Ultimately, cycles will take hold. We can prolong a cycle. And, Trump was very lucky when he came into office in 2016. He was extremely fortunate because in 2017, we got slammed with 3 major hurricanes and 2 major wildfires, which caused a massive amount of stimulus to hit the economy because we had to repair all this stuff, right? So they gave us this short-term economic boost. This year, we don't have any of that going on yet. Now, we're about to enter hurricane season, so fingers crossed.
If we
can wipe out a couple of cities, we'll be good.
Yeah.
But if repairing cities is a good thing economically speaking long term, we've got nukes for that. What we need though is real organic economic growth, and that's hard to achieve when you're at full employment, when you are at peak asset values, when you're at peak investment structures, where people are fully engaged. Growth is about what you add incrementally, but if you're already fully engaged, it's hard to incrementally add anymore. So this is why cycles eventually take hold.
Well, and this could play a lot on the election. We know that he's going to try to prop everything up as best he can, right?
Yeah.
And there's good data out there. There's good information, There's bad information. But like you mentioned earlier, those leading indicators starting to suggest that there's some flashing lights, some warning signs. And so when you're heading into retirement, and even if you're not, if you're younger, I hear people all the time who are my age, 30s, 40s, 50s, and they're saying, hey, oh man, I'm not worried about it. I'll buy and hold. Great. We're very short-sighted, and a lot of times I think it's because of this influx of information. When you go back, you mentioned 2013 to get back to even, people call that 2000 decade the lost decade because you didn't make any money. But most people didn't feel that because they're still contributing to a 401k plan. And so as you're contributing, you're taking advantage of lower asset prices. That's great. But if you had money there or you were actually in retirement taking distributions, I would venture to say most people never got back to even.
Right.
And so that's where you see a deterioration of capital happen so quickly. And those are the things that we talk about in our workshop this Saturday. Go to realinvestmentadvice.com. There's a banner right there. You can go sign up. We'd love to see you guys out there. It's very open format.
What are you selling?
Nothing. Advice, expertise. This is a PSA. It's a public service announcement. We want to help you guys get ready for retirement, get there. Look, you guys know what we do. We love to help you any way that we can, but there's no products. And that's one of the kickers. Most people say, where's the product? What are you doing? Like, we are the product.
Yeah.
It's us.
And that's why they don't charge, because it's them. We'll be right back after the break. Wrap up the show. We'll talk a little bit about trade, what's happening this morning, what the big fizz are. Futures down about 50 points on, about 133 points on the Dow right now. NASDAQ down another 52, and the S&P looks to be down about 18 to 20 at the open. So it's going to be kind of a sloppy start this morning. It'll be important to see where we wind up by the end of the day. So hang around. We'll come back. More of that coming up in the Real Investment Advice Show right here, realinvestmentadvice.com. Don't go away.
Get along without your way of go. You took me for everything that I had and kicked me out of my home. Are you happy? Are you satisfied? How long can you stand the heat? Out of the doorway, the bullets rip to the sound of the beat. Yeah.
Catch Lance Roberts' podcast later at lancerobertsshow.com.